Good morning, everyone. I'm Raphael Lim, a correspondent at the Business Times. On behalf of SPH Media and our partners, FTSE Russell, the Singapore Exchange, and State Street Global Advisors, welcome to BT's Roundtable webinar, Grow Your Portfolio with ETFs, or Exchange-Traded Funds. It's rather timely for us to be discussing this topic today. As we know, global markets are experiencing significant volatility this year, with inflation and rising interest rates at the top of investors' minds. Stock indices that were at record highs are seeing corrections. The S&P 500, for example, last week was close to bear market territory, down 20% from its highs. On the other hand, there is also the Singapore market with the Straits Times Index, or the STI, which has shown resilience this year. As of yesterday, the STI was up 1.8% for the year to date, quite a bit better than some of the regional indices. And this year also is the 20th anniversary of State Street's Spider STI ETF, which is one of the largest ETFs here with over 1.6 billion Singapore dollars in assets under management. So really, the current volatility and diverging performance of different assets and different markets makes it an interesting time for us as investors here. Is it a good time for you to be buying the dip and adding to your portfolio? How can you identify different ETFs that can outperform or, at the very least, be stable and resilient amid some of the volatility? How can you make more efficient investing decisions by tapping on some of the benefits these structures can bring, such as diversification or lower costs? So we are very pleased this morning to have with us a panel of experts who are closely linked to the industry that can help us answer some of these questions. We would also like to thank the audience for some of the excellent questions you submitted at registration. We will get to some of these during the session as well, so do stay tuned. Without further ado, let me introduce the panelists that we have here today. So joining me in the studio, we have Geoff Howie in the center. Geoff is a market strategist at the Singapore Exchange. On the right, we have Kheng Siang, APAC Head of Fixed Income and Head of Singapore at State Street Global Advisors. We also have joining us virtually with us this morning, Emerald Yao, Head of Equity Index Product Management for APAC at FTSE Russell. So Emerald's dialing in from Hong Kong this morning. So welcome everyone, and thank you for joining us this morning. So really, let's kick off the discussion. Geoff, I think we'll start with you today. ETFs has been growing in popularity worldwide. Perhaps provide some context for our audience as well. What are the most popular ETFs that are listed and traded in Singapore, based on Insti and retail?
Okay, well, overall, institutions make up around 70% of our AUM, and the retail investors make up about 30%. Now, that has been consistent during the very strong growth in AUM and ETF participation, particularly over the last 2 to 3 years. We've seen the number of retail investors who are active in our ETF market triple over a 3-year period. And the ETFs that are mostly participated in really reflect a very strong focus on both Singapore, the region, some cross-asset, as well as some risk management through the use of the gold ETF. So if you look at the 5 most traded ETFs so far this year, amidst the volatility we've seen in early 2022, you've got gold ETF the most traded, the Spider STI ETF the second most traded, you have Kheng Siang tech stocks, you have the ETF that focuses on the corporate high yield bonds, as well as the China government bonds. Now that's very similar to last year, but the difference was we had the other STI ETF among our top 5, and the China government bonds were not among the top 5. But China government bonds at the end of last year were yielding 2.8%. I still think that's pretty competitive with the US 10-year yields at the very moment. And of course, as we said, that STI has been a very popular ETF for many, many years. And just to make one final point on the growth, at the end of 2019, we had 5.5 billion Singapore dollars of combined AUM of all our ETFs. And then by the end of 2020, that had risen to around 8.6 billion and then was at 12.6 billion at the end of last year. Now, AUM has grown in terms of the number of investors and participation in those ETFs, but we've also listed new ETFs over that period, and that has been a big part of the AUM growth, contributing to around a quarter of the current AUM.
Right. And those are interesting points. And I mean, we'll get back to some of those later on the specific ETFs and the attributes of some of them. But right now, I mean, with the growing retail volume, as you mentioned, retail interest in ETFs, I think we'll turn to Kheng Siang. And really, like, are ETFs better or more suitable for the average retail investors compared to holding stocks or mutual funds? What are some of the compelling attributes for the average guy?
Sure. If you do consider buying individual stocks, you are taking a bet on just one single company. And so therefore, you're going to make sure you really understand the business model and the performance of those companies. But if you're investing into ETF, you're investing across a set of companies through just one particular counter. And that itself gives you the diversification benefits that you would enjoy. And so therefore, it really gives you a lot more better protection, because in some cases, one particular company may be doing a lot better during certain business cycle, and the others perhaps may be doing slightly less well. But if you're investing into one single stock, if you are riding on the right stock, then obviously you do very well. But if unfortunately you're on the other side of it, that you will be underperforming tremendously. Now, going through an ETF route, it will give you a basket approach, a portfolio diversification benefits that gives you a better smoothing effect on the long-term market cycle.
Right. Okay. And I mean, there's also some of the benefits people have talked about ETF are some of the costs involved in it as well. Perhaps you could maybe touch a little bit about that as well and how investors can think about it. Yeah.
In terms of costs for trading, if you're trading individual stock, obviously you have to pay your stockbrokers, the commissions and so on. And if you are trading the mutual funds, there are some upfront fee charges that the distributors, could be banks and various platforms that you are investing through. Now, if you're buying an ETF, apart from the stockbroker commissions when you're trading like a stock, you really have a very low cost structure in terms of total expense ratio for ETF. That itself, over the long run, would help you to gain a better efficiency in terms of your investment performance. Because bear in mind that when investing in stocks or anything else, there are management fees, there are also various other charges involved. If you are able to invest in a low cost fee structure product, that itself would help you to minimize some of the expenses that you incur over the long term. And investing is really for long term, right? We are not just looking at a short-term punt in any market direction.
Right, yeah. And I mean, like, ETFs mostly they are tracking an index. So at this point, I would also like to bring in Emerald from FTSE Russell. Perhaps you could share a little bit more with us, what really goes into the creation of an index and how do some of these indices evolve over time?
Sure. An index, very importantly, you need that to be tradable. You need that to be investable. Otherwise, that there's not really usage of that index. In designing an index, we need to pay attention to the objective. What are we trying to achieve here? What should the outcome be? So you're going to ask questions like, well, are we creating an index that represents a particular market? For example, like the STI index that would represent the Singapore equity market. Do we want to limit the number of the constituents for easy trading purpose? Like in STI's case, it only consists of 30 stocks. Or do we want to create an index that capture an investment trend? And if so, we might want to go down the route of creating a thematic index, which offer a more agile approach in terms of selecting constituents across sector, across sizes, across geographics, and the list go on. But the key here is that the outcome needs to be a tradable, investable index. But obviously, because of different objective, different market segment that the index is capturing, that will lead to different performances as well. So, like in terms of total return, which is basically with dividend reinvested, NASDAQ 100. This is index, focusing on the growth stocks in the States. So that's been struggling this year with the rate hike environment. That's down 27% year to date. And STI, but by nature of Singapore market, it is largely a value stock type of index dominated by bank exposure. That total return is actually even higher than what Raphael has quoted before, because here I'm talking about the total return with the dividend reinvested year to date, up 3.8%. So that is quite significant. And you can see it is representing the market, and as investors choose the indexes, they should be getting what is really true, representing what they're looking for. Now, second part of the question is, do they evolve? Yes, they do. I give you a very example on the STI. So they do evolve, with different reasons. In terms of STI, this is an index launched in 1966, probably older than many of us here. That is, one of the oldest index in the world. It's only 9 years younger than the S&P 500 index. So at launch, it was actually not the Straits Time index. It was the Straits Time Industrial Index, because at that time, the industrial companies are more important to Singapore economies at that time. But because Singapore economy develops, the index subsequently expand to beyond industrial company and transform that into today's Straits Times index in 1998. But then it transformed again in 2007. It got revamped into its current form. The number of constituents actually got cut from like a floating of 40, 50 constituents to down to a fixed 30 constituents. So that is what you see today. So a very long time, 56 years of transformation of the index from 1966 to now. So can there be next evolution? Anything is possible, but it all depends on what the market needs, what the regulation requirements are, etc. So it's interesting work over in the index.
Right. I mean, that's a very interesting overview on the importance really of the index methodology and the components when it comes to deciding on where to invest in ETFs. Maybe we'll go back to you, Kheng Siang. When people select individual stocks, really, I mean, they look at the fundamentals, they look at revenue, profit growth, dividends, and then bottom-up analysis and go in. I mean, for selecting an ETF, would it really be just top-down and like understanding the methodology of the index?
I think there are a few things to consider. Obviously, you need to select a particular ETF that is, first of all, has the index that suits your investment need, right? So first of all, the index brand is also important, like the particular index, the scope, the constituents within that. And secondly, then you look at the manager behind that, because that's a very important aspect. The performance and the track record of the manager and the entire ecosystem supporting the ETF is very important. Now then, when it comes to the selection of ETF itself, investors need to kind of pay attention to this time we talk about cost, right? So for example, the STI ETF, the expense ratio is about 30 basis points. And if you were to buy a mutual fund, could be upfront charges of up to like 5%, depending on, maybe some negotiations, and also banks will differ. So I think when it comes to the selection of the ETF, that's what you need to consider. But what drives the performance of the ETF is the market effect. That is something kind of a bit different from the individual stocks. Individual stocks, apart from the market effect, it is very idiosyncratic, meaning that it's the individual company performance, whether there's anything happening with the corporate actions side of the company. Whereas you're looking at the ETF, because you're buying a basket, a lot of macro factor drives the performance, right? Some of the policies that the government put out for the industry or for the country itself, and how the global investors view, for instance, Singapore. That itself will be also a very key important indicator. So I think investors then have to look at, when they invest in ETF, there's a lot more macro factors that they need to pay attention to.
Right, okay. And then maybe it's just a follow-up on that point. There are so many different ETFs in the market. Some of them are tracking the same benchmark, tracking the same thing. For the average investor, what should they compare? Like really, is it liquidity or expenses, or are there other things?
Yeah, there are a few things. If you have something which is identical and if you assume even the index is the same, then it's really down to the manager and the product design, right? And the product features. I think this is what you need to look at. So expense is just one thing because different fund might have different expense ratio. So the cost structure itself over time may actually create a performance dispersion between the two ETFs. Other than that, and when we look at the ETF itself, we need to consider the support network, right? So you have the authorized participants and also the market makers. So these form very important partners for the ETF product, whereby that will provide the liquidity that investors need. So when investors are buying on the retail side, they may not really see that because they are only seeing people are buying or selling. But having a proper structure of the market makers and the ecosystem supporting it, that can provide a longevity for the product and the success for it.
Right, so quite a bit of things for investors to consider then. Maybe turning back to Emerald. Mostly like ETFs, they are created when there are new indices to track and based on changing investors' demand. For FTSE Russell, which is an index provider, how does it really decide on when it creates a new index and what are the components in that index itself?
Well, in a nutshell, FTSE Russell creates two types of indices. There are standard indices and there are customized indexes. The most important of all, in the construction, it needs to be rule-based. It's not something that, we say, hey, this stock should go into this index and that stock should go into that index. That's not the case. So it has to be rule-based. So first of all, standard index, what are they? Well, they're standard, right? These standard indices are meant to be useful to a wide range of investors. So for example, STI is a standard index, or our flagship global equity index series is also consists of a range of standard indices that has cover global, regional, single country, capped, uncapped, sector, etc. So new indices, new standard indices can get built over time, under the existing index series, but it's also can be completely brand new series that get built. So as the market and as the demand develops. So for example, we rolled out the standard FTSE thematic index series last year using the latest AI machine learning type of techniques to create a flexible index construction approach. So we have a range of standard methodologies also that we can overlay on these indices. For example, style indices that separates the growth and the value components in the indices. There are smart beta indices for factor investing. There's obviously, very hot in topic now on sustainable investment. These methodologies are definitely growing very fast. We have a wide range available to overlay on, simple vanilla type of indices as well. So from things like, exclusion list, fossil fuel exclusion, for example, method that's based on ESG score, carbon focus, TPI climate, Paris aligned. So there's a range of things that we can do, in the standard index as well. Now, on the other hand, what are customized indices? Customized indices are more of a product that is generated between index provider like us and the client. They might have specific requests that deviate from how we create our standard indices. Now, that's why we have to work hand in hand with the clients on these specific design needs. So, for example, a client could be asking, I don't want that many constituents. Let's put a floor on the constituents rate. I want to install the minimum constituents weights, taking out anything that is, say, lower than 10 bips, and reallocate the weights to other constituents. Or the client can have a specific demand on how the sustainability calculation is done. So, these would be outside of the range of standard indices, and this will be, the so-called customized indices. But again, whether it's be, standard indices or customized indices, the key point of an index is not to be modeled with a human. It needs to be rule-based.
Right, so rule-based indices and not modeled by humans. And with so many indices now, for investors, I think it's a challenge or an opportunity to really decide and think of what to invest in given the current macroeconomic conditions that we have. So turning to Geoff, currently the macro situation, we are seeing inflation at multi-decade highs, and there's also concern that central banks will need to go very aggressive to tackle that. So how does the macro conditions affect how investors invest in ETFs?
I think it's, well, first of all, the macro conditions have seen very measured moves across the various asset classes, across the various sectors. So with inflation, there's two key drivers of inflation, obviously: higher energy prices and higher shipping rates, supply chain bottlenecks per se. Now, because of that impact of energy, you've got globally energy stocks, utility stocks, as well as this supply chain issues being exacerbated by the Ukraine crisis, which is now 3 months old. You've got agricultural affected stocks also pretty strong as well. Now, if you had an index that was predominantly energy stocks, utility stocks, and agricultural stocks, obviously it would be performing very differently to an index that was focused on technology, which is grappling with higher energy costs, grappling with the supply chain constraints, as well as potential interest rate rises that aren't necessarily going to address those higher energy costs and the higher supply chain costs. So for that reason, technology has been the actual least performing sector across the world. That's why the developed market is down around 15% year to date versus the more defensive return for our STI stock. So really, it's what happens in the markets really also do determine what the investors do. So, for instance, as I said before, the AUM of all our ETFs has grown significantly over the last 3 years. A big part of that is actually Singaporean investors participating in the STI ETF during that volatility of 2020. So, for instance, our State Street STI ETF, which launched in April 2002, has just surpassed 20 years old, obviously, having its 20-year anniversary this year. And then we had the other STI ETF listed, I think, February 2009. Now, combined, it took 17 years for those two STI ETFs to reach $1 billion Sing dollars in AUM. Because of the volatility of March 2020 and for the remaining of 2020, we saw it only take another 17 months for the two ETFs to reach $2 billion in AUM. So the market volatility obviously plays a big role into it. As Kheng Siang was saying too, costs matter as well. And over the last 2 decades, the average fee paid for a fund has actually more than halved from, I think it was 93 basis points in the year 2000 to around 41 basis points on average in 2020. And that 0.4% rather than 0.93% saves investors over the long run a lot of money. And if you look at our AUM, in terms of our 12 to 13 billion AUM we have right now, around 60% of the AUM is in those ETFs that have a total management fee or access fee actually less than 40 basis points. So fees, market moves, obviously are big determinants. And obviously, as I said, the moves are measured. So having an ETF field that is very diversified over the different asset classes and to the sectors where we can, obviously makes a big difference for the investors. Right.
And I mean, on your point on, really investors flocking into the STI during the period of volatility in 2020. I mean, 2022, well, we are not really at that level where there's indiscriminate selling yet, but do you see it as a time where investors might really be more interested in something that is more stable and defensive?
Yeah, and we've seen more inflows actually in the month of May for the actual STI ETFs compared to earlier in the year when we were touting just how well it had performed. We saw bank stocks globally come off a little, and that obviously has weighed the STI from those 10% year-to-date gains to 1%, and that has seen some more rotation into the STI ETFs. Also, don't forget we've got the regular share saving investors as well, who don't go lump sum and actually dedicate an amount of their investing portfolio to the STI to set price at the end of every single month, therefore dollar cost averaging. But can I just also say just one more point on the ETFs too? It's not the AUM and so forth, we're not throwing, there hasn't been an element of throwing caution to the wind either, because I think one key factor of our ETF market is we have specified investment products. So if the ETF is more complex in nature with its structure and not so much cash-based, and more hands involved in building that ETF, investors actually do have to pass a quiz to demonstrate they actually understand the risk. And that's been in place pretty much since 2011, when a Bank of International Settlements paper came out addressing, it was paper 343, basically addressing the market structure and the risks of ETFs.
Right, okay, so there is like some sort of safeguarding on the understanding before you really go in.
Yes.
Right, okay. And I mean, bringing Kheng Siang in as well, I mean, any views on the current macro conditions, you know, and really ETFs that could be of interest or sectors that they want to diversify into?
Yeah, I think currently, given the market situation, you know, we might expect more volatility. I think that's a given thing. Given that we are in a position whereby, you know, interest rates are rising in response to inflation and to Geoff's point earlier, and the various challenges that we have seen globally. So I think investors need to stay nimble. Now, I guess the way to look at investing is having a core portfolio, right? So if you're a Singapore-based investors, which I assume that the audience is, then you need to have a core investors, core portfolio for your investments. And then you have a satellite approach to try to look out for potential other areas that you could generate extra return from. And that's where I think you can consider some of the regional theme type of ETFs, and you may have to consider also global, right? Because you know, you never know that some of the global trends could also be very profitable over medium to longer term. And within that, you can also consider the mix of equity versus fixed income. I think that's also, I think, for investors need to consider, because for fixed income investing is very difficult for individuals to buy a single bond. But if you buy a bond ETF, that gives you the instantaneous diversification. I think that's where I think investors can consider at this point, having a core portfolio and use a satellite approach to look out for other more interesting sectors for them.
Right, so it's like geographical diversification, some asset class diversification as well.
Yes.
How about like, you know, the commodities? I mean, like gold as a...
Yeah, I think certainly in times like this, we are seeing the commodities doing very well. So naturally, you may want to position for that, because commodity is also a good inflation hedge as well. So from that standpoint, have that. Now, gold itself plays a very important role in situation whereby there's a rise in risk aversion. So I think investors can have some protection in those areas, whereby they can help to cushion some of the potential downside for other sectors that they invest in.
Right, okay. So I mean the cushioning and defensive nature of things is something that investors should be thinking about, it seems, at this current period of macroeconomic uncertainty. You know, bringing Emerald in as well into this topic, are there any FTSE indices that really have constituents which investors may be more interested in, given, I mean, which have more defensive components in them that you know, investors could think about?
Yeah, certainly we have a wide range of products, so that are definitely something that could work under this market environment. As you know, Geoff elaborated early on, you know, STI has worked pretty well. It has attracted quite a bit of investor interest, and with the EM doubling in recent years, you know, STI actually, you know, total returns up 3.8% year to date compared to, you know, S&P 500 for, you know, 16% year to date. So why does you know, STI works well? Because it is more value stocks dominated. There is no technology industry in the exposure in the index, so it's already pretty defensive in the nature. The top three stocks are DBS, OCBC, UOB. So these are the really large known banks in Singapore. They total of you know, an index weight of 45%, and these are quoted as the APAC safest banks. And they also offer pretty decent dividend yields. And these banks, you know, they are, you know, also in the top 10 constituents in, say, the FTSE APAC Sustainable Yield Index. Now, talking about dividend, there's also seeing an increase in REITs exposure in the STI index. These are dividend-paying securities that can elevate the overall STI's dividend payment. So dividend yield of STI has been hovering around 3.3 to 4% for the past decades or so, and now at 3.5%. Now, this is important, particularly in a volatile environment, because dividend return is always positive. You will get the money, you will get the income. And, in a volatile market like now, a dividend return can always, be a cushion in this environment. This is, a safe fallback. Now, similarly, FTSE 100, which is the top 10 UK listed stocks, these are also dominated by value stocks, and this index total return has gained at 3.6% year to date. Now, other bright spots in the region, we have FTSE Indonesia. This index is focusing on the Indonesian equity market, so Indonesia has been benefiting from a stronger growth. This index seeing a total return of 8% year to date. And obviously, there's also on the other side of the world that we have FTSE Brazil. This index has gained over 20% because they have large oil company, commodity company like Vale. But as emerging markets, investors need to be a bit careful, brace for the volatility, watch out for the valuation surge year to date in Brazil market. And outside of these, like just single country type of indices, we can also consider, the FTSE Global Infrastructure Index, which could maintain, has maintained a pretty stable footing actually in an inflationary environment. There is FTSE APAC REITs indexes. Similarly, there's strong income stream that's at play here. And then the other one that's, one of the things that I've been talking to investors about is the FTSE Big 30. So this is a frontier market at the moment, but, this can benefit from, supply chain relocation, potential upgrade to emerging from frontier markets in the future. So, that's a lot of example, but, I'll stop here.
Yeah, no, I mean, that's fascinating. It's clearly, a lot of headlines have focused on how many markets have corrected, but from what Emerald has said, there's actually quite a lot of pockets of performance or stability in the market that investors can be considering for their portfolios as well. And I believe there would be ETFs that track some of these indices as well that you definitely can think about. But I mean, turning to Geoff, I mean, we talked about STI and some of these global ETFs over here on the local bourse and what are traded in Singapore. What else can investors be considering among the pool of ETFs? Could you just give us a flavor of what's available? And
yeah, I mean, absolutely. Emerald was discussing the Indonesian market, and our Indonesian ETF has actually been the strongest, as the Indonesian index has also been among the strongest in the world so far this year. It's strongest in terms of performance, and then Vietnam was the strongest performing last year. But we have quite a lot of variety. When you look at the assets that we cover, we obviously have equities. So you have developed markets and emerging markets as part of those equity ETFs. You have REIT ETFs, which are not just Singapore-based, but you have APAC facing as well. Then you have the gold ETF, which does represent to the World Gold Council a great method to diversify portfolio against volatility, because gold is ultimately the least correlated asset class to all the other asset classes, and hence has that still that safe haven status. World Gold Council suggests anything from 2 to 10% of a portfolio might want to be weighed to gold in terms of when you're facing volatility. Then, of course, we have the fixed income, which Kheng Siang was talking about. That's very important as well. And not just having fixed income that's Singapore-focused, but also China-focused, Asia, and the US as well. So there's quite a lot of variety in the 30 or so ETFs that we have listed there. We do cover quite a lot of asset classes. The region's very important as well, and the core satellite can come into play there as well. As Emerald was talking about, Indonesia performing very well, and as I said before, utility and energy is performing very well. Well, within the STI, our two strongest stocks so far this year, which have been pretty much neck and neck all year, particularly more recently, Jardine Cycle and Carriage, which has the Astra International Car business in Indonesia and is the Jardines Group ASEAN vehicle. And then, of course, Sembcorp Industries has been there as well. So a lot to choose from. And as Emerald said, the banks are there as well. So if you wanted to really have more focus on the core of the STI, such as the three banks, you could also take exposure in the stocks, which are obviously, from a macro perspective, they perform pretty well. Net interest income is up, non-interest income is up. Non-interest income in the first quarter of this year was up more than the net interest income, even though the outlook for rates is up to around 275 to 300 basis points at the end of the year. Nonetheless, we have that wealth management growth in the region, which you were talking about before, as a driver.
Right. So I mean, so you're mentioning core sets, like how people can use the STI ETF or any ETF as a core part of the portfolio and have single stocks.
And different sectors representing so much of the world and so many different sectors and industries.
Right, so there's different opportunities to think about.
Yeah.
And maybe bringing Kheng Siang in at this point, I mean, for a new investor, is there really an ideal number of ETFs to have that a portfolio should be thinking about? Is there a number that's too many, like 20 ETFs, is that too many?
Yeah, I think that's an interesting question because at the end of the day, investors need to assess themselves, right? How many things they can focus at any one point in time. While having too many gives you a lot of diversification, it also means that you need to spend a lot of time to look at every single thing. I don't think there is a kind of holy grail answer for that. I think investors need to kind of look at what really matters for them, right? If you look at your entire investment portfolio, perhaps you kind of divide it into several buckets, right? And then from there, you just choose perhaps one fund or maybe maximum two, I guess, to represent that particular sector that you have an interest in. I think if you stay with that, then it is sufficiently enough, I feel, for an individual to keep you sufficiently busy rather than having to kind of looking at too many different things and you lose focus in the end. I think that would be a more simplistic approach that is still manageable from my point of view.
Right. So don't be too ambitious and try and find everything.
That's right.
Really, really be targeted and focused.
Yes.
And I mean, it comes back to kind of the core satellite thing you're talking about as well, right?
That's correct. I think if you are having too many satellites, it also means that you're actually very difficult to kind of make the focus. Right? And if you want to do the adjustments, you need to trade many different funds. Right? I think having a representative fund for each of the particular areas that you want to focus in, I think that itself would be just sufficient.
Right. Okay. I mean, that is something for people definitely to think about. What is within your ability of your time? How do you manage everything, your resources adequately as you look where to invest it? I mean, we're coming to about 15 minutes towards the end of the session, so I think this is the time where we can dive into some of the questions that the audience have submitted earlier on. So I guess while we're on the topic of core satellite portfolios as well. Really, I mean, like ETFs, there's ETFs for almost everything, right? I mean, there's like metaverse ETFs, there's crypto, people look at crypto as well. So do these things have like place in people's portfolio? Maybe Geoff, do you have a view?
Yeah, I think, well, it's obviously all comes back to the individual in terms of what their appetite is for risk and return. Mm-hmm. But I think investors can find out by working with the issuers. Education has been a very important part of the retail growth in Singapore for its ETFs, and we are getting more, businesses that are involved with ETFs, like the robo advisories and so forth. I think we have close, as I said, 1 billion of AUM associated with the robo ETF investing platforms. Now, they offer not just ETFs here in Singapore, but across the world. But what they also offer, like take Scythe, for example, that spends a lot of time on investor education, basically letting investors understand more about the structure and the behavior of these particular indices that the ETFs track, as well as all the inherent risks. So I guess in terms of what the investors would like to invest in and follow, we have a very supporting industry that is working very hard to make sure the right education is available.
Right, okay. Yep. And another question that investors, I mean, some of the audience have asked also is really like buying ETFs locally versus abroad. I mean, maybe Kheng Siang, you can take this one because State Street has quite a wide pool of assets. How different is it for investors, and what are some of the things they should consider one way or the other?
Yeah, if you're buying a local ETF, obviously you have a stockbroker that you probably know very well, and they can service you very well. And one thing is that you only stay within that country or currency, right? So if you were to buy a global ETF, it could be different because the constituents of the particular ETF or fund itself would be of having foreign currency effect, right? So that could be still translated into Sing base. So when you trade, you still be Sing dollar, but again, you need to be aware that you have that currency risk effect. And when you trade on the overseas side, there could be potentially different type of cost that you have to pay. So depending on where it's listed. So again, that's an important consideration. So I think when you're investing local versus global or international, I think you need to kind of pay attention to that.
Right, okay. Another question is, is buying ETFs, in the long term without really looking at what the market does a good strategy? I believe this comes in a little bit with dollar cost averaging, the regular savings plan and passive investing. Emerald, do you think you could help us with this one?
Yeah, sure. I think the investor needs to understand what is my core investment versus what is my tactical investment. I mean, you talk about metaverse, you talk about different, trend before, but there gotta be, the core one, you need to stay long term, despite, there will be markets up and down, so be afraid of it. If your investment horizon is long, you can hold those, but tactical, you might, need to pay a little bit more close attention to. That's when is a good time to, go put a bit more tactical allocation in whichever segment. So I think it depends on, what is your, horizon, and obviously what is a core versus a tactical.
Right, okay. Yeah, I mean, I think that's an important point to highlight, and to separate really what is there for the long term and what's a little bit more trying to beat the market or find some outperformance. In the Singapore market, at least, I think a lot of investors look at dividend investing and regular income flows. So we also have a question from the audience that asks, should I invest in ETFs or REITs for dividends? Maybe Geoff
Can do both.
Yeah,
Can do both, because we now have REIT ETFs that are listed, right. And there are obviously different yields for the 40 or so REITs that we have listed, and different yields for the ETFs. I guess it's up to that investor to have a look at the prospectus and the information on the ETFs that do track the REITs. We have seen good growth in the AUM as well as trading turnover, particularly if you look over the last couple of years in terms of some of the most traded ETFs here in Singapore. There was a focus, you could see there was definitely a focus on demand for yield. So it's definitely there. As we said, you can do both.
Right, okay. And I mean, we talked a little bit about total returns from STI and also the yield, the dividend generation from it. What other ETFs can investors, really consider that kind of bring that sort of stable
yield?
Income? Yep.
Well, there's actually quite a, there's quite a lot of yield branding with our stock market, because as Emerald at FTSE, as we were talking about before, every month there's this report that we can combine all the stock markets across the world and see just who has the highest yield. Now, recently we've been outpacing developed markets, so we've come down a little bit in the rankings. But traditionally, for many years, we've ranked among the strongest, certainly regional stock markets with the highest yield. So there's a lot that investors can look at in there. If you wanted to look at the actual stocks themselves with the ETFs. For instance, there's also a FTSE high yield index, which actually does not take REITs into consideration. So it's more the corporate high yields. It's a global index. And we almost double our impact in that compared to the FTSE World Index. So we're blessed with riches when it comes to yields. But if investors wanted to look at the STI, for instance, if you look at the STI since the State Street ETF listed in April 2002, it's generated 6.2% average annualized total returns. Okay, since the end of 1966, Emerald mentioned the base date, 30 December 1966, the STI base date of the industrial index that back then was 100. That annualized price return to date is around 6.2% thereabouts as well. Now, how much of the yield makes up of that? Typically, yield stocks in Singapore for the STI, typically the yield is around 4%. For the REITs themselves, they're up towards 6%, but it can come down a little bit when you look at the actual REIT ETFs. That can be a little bit skewed to the bigger ETFs, the more traded ETFs, a little bit more weighed to the bigger ETFs that have the lower yields than the more mid to small cap ETFs, REITs that can have the higher yields.
Right, okay. And there are also some members of the audience who are curious about sustainability. I mean, it's the thing that everybody's talking about right now. How do like passive investing and ETFs tie in with all this? I'm not sure, like Kheng Siang, would you want to?
Yeah, I think certainly the market focus is shifting. I think it is as I may call it, a generational shift in terms of investment focus. Clearly, ESG theme is on the top priority of many investors, including us. So I think investors, when you look at your portfolio, you may want to look at where you can incorporate some of the ESG related aspect into investment. Now, there are some funds which are dedicated ESG. There are some funds which are not, but they could be ESG tilt. I think sometimes it is hard to have everything 100% ESG compliant because it is tough, right, to really just find all the ESG assets. But I think we need to move there. I think the incremental move is an important signal. I think investors can take the first step, trying to identify some of the funds or ETFs that may have a tilt towards more ESG direction. I think that's one direction I think we should all do.
Right. I mean, Geoff, you have something to add?
Yeah, we have 4 of them as part of our ETF suite that are linked or I guess sustainably linked ETFs. They have global assets of around $700 million, of which $200 million is here in Singapore, and 3 of those 4 have listed in the last 6 months. So there's a lot of growing demand. As we say, there's education on it as well. On Tuesday night, I was sitting in a UOB asset management presentation on their green REIT ETF.
Right.
So there's a wealth of information there too for investors.
Right. So I mean, clearly there are products that's already catering to investors. I mean, Emerald, anything to add from your side on?
Yeah, it's actually interesting. I mean, for the past years, there has been an increase of inquiries on building out the sustainable investment type of index. That is why earlier I mentioned this space is growing really, really fast. The methodology are evolving. Just given the market development, and we certainly are seeing, I mean, not just in Singapore but across the globe, there is the trend to move towards this. Even companies that used to have just a plain vanilla equity ETF, those might just transform to somewhat sustainable investment type of investment index. So focusing back on the same market, but with the overlay of sustainability. So it's this certainly is moving fast.
Right, clearly fast moving. And maybe just one last question from the audience for today. So somebody's asking, how much risk do you see potentially that ETFs has created a bubble? I guess this is the rise of passive investing and popularity investors. I believe the ETF total AUM last year was exceeding 10 trillion at one stage. So I mean, somebody's asking, is this really driving increase in asset prices in a bubble? You want to take a stab at that, Geoff?
Yeah, sure. I mean, $10 trillion is incredible when you consider, and I know that's multi-asset, but you consider that the global stock market is $100 trillion. So those amount of assets that are basically being tracked in the ETFs and being invested in the ETFs is very strong. It's grown significantly. There are risks, of course, and as we said, there's plenty of literature on that as well, and especially following the global financial crisis. So if investors want to know the difference between a cash-based ETF and a synthetic-based ETF, there's quite a bit of difference there in terms of the risk profile of the ETF, and that's where I would recommend the investor reads up. But look, at the end of the day, it's the product itself has, I think, been a game changer for financial services globally, okay? You've got an index that you can invest in. It's not a stock like Kodak that can lose its relevance. It's an index that, in a way, is a portfolio strategy itself, always investing in the biggest and the most actively traded stocks of your market. So, as we said, our STI, it's been around for more than 50 years. This ETF has now been around for more than 20 years.
Right, okay. Yeah, so I mean, really you have to look at it individually as well and think about it. I mean, we've got about 5 minutes left for this session, so I think what I'll do is I'll go one final round with all the speakers. What is really a final piece of advice you would give to our audience, especially those who are new to ETF investing? Maybe we'll start with you, Emerald.
Sure. I think all of us have touched on the various parts of, how to look at an ETF. Is it sizable? Is it liquid? What's the ongoing charge, the total expense ratio, the TER? What's the tracking difference versus an underlying index? These are all good questions to ask, but I want to, point out one thing is that don't ignore the index that is actually behind the ETF. An ETF does track an index. An index with similar names can consist of quite different composition, particularly across different index providers. So make sure an investor, if you're looking at an ETF, make sure you understand what that index is representing, whether it is representing what you're actually looking for.
Right. Okay. Kheng Siang?
Yeah, I think the thing to look at is just remember that ETF is just a vehicle for a fund to trade, right? So it is not something totally new, right? So you are just investing in a portfolio of stocks, and that particular portfolio is exchange traded. I think that's what's important. So investors need to focus on the education, understanding the structure of ETF, and as Emil talked about, you need to really understand what is behind that. So the index is important, the manager is important, the track record, and then from there you can have a better grasp of what the ETF would mean for your portfolio.
Right. Okay. And Geoff?
Yeah, and I think just to sum it up, because ETFs stand for exchange traded funds, what they really do is bring an element of efficiency, transparency, and flexibility to the old way that fund investing was done.
Right. Okay. So I guess those are things for investors to think about as you go about your investing journey. I think that's about all the time we have today, everyone. So a very big thank you to our panelists, Emerald, Kheng Siang, Geoff, for sharing your expertise with us. I'm sure the audience would be able to use these insights in their investing journey. Thank you very much to our audience as well for spending the past hour with us, learning how to grow your portfolio with ETFs. Do stay connected with BT as you continue your investing journey, and we hope to see you at our future sessions as well. Thank you and have a great day, everyone.